Hello and welcome back to the Live for Today, Plan for Tomorrow podcast. I'm your host, Gabe Bodner. It's great to be back. I've taken a little bit of a break from the podcast, so I apologize for the listeners ultimately who have been missing out on this podcast. But I'm excited to get back on track, excited to have a new episode today. Today, we're going to be talking about the 5 primary myths or misconceptions about reverse mortgages. There's a lot of myths and misunderstandings with reverse mortgages. However, today I want to focus on the top 5. Okay. So without further ado, let's dive in. Now, the number one most common myth with a reverse mortgage is that your home must be free of any debt, like a mortgage or a home equity line of credit, and that you must own your home free and clear in order to qualify for a reverse mortgage. That is absolutely false. One of the most popular reasons, actually, that homeowners do reverse mortgages is to pay off an existing mortgage or pay off a home equity line of credit, also known as a HELOC. And again, you do not have to own your home free and clear. So let's dive into that a little bit. Now, a reverse mortgage has to be the only loan or the only lien on the property. That's where I think this myth comes from. Okay, so let's break this down. Let's say you own a home that's $500,000 and you have a mortgage balance of $100,000. If you can qualify for 50% of your home's value, let's say $250,000, the reverse mortgage can come in and pay off your existing mortgage of $100,000 in this example. So what that's going to do is it's going to pay off your existing mortgage. That's going to be removed from the title of your home, and we're going to replace that loan with a new loan called a reverse mortgage. It's that simple. If you've ever refinanced a mortgage in the past, this is doing the same exact thing. We are paying off whatever mortgages are on the title of your house today, and we're replacing them with a new mortgage, once again, called a reverse mortgage, that doesn't require monthly payments. Hopefully, that provides a lot of clarity, once again, on the number one myth about having to own your home free and clear. All right, let's dive into number 2. Number 2 myth is that the borrower's heirs or the borrower themselves will be left in debt in excess of the home's value someday. Okay, so the, again, myth is that if you do a reverse mortgage, it's possible, because what happens is if you don't make mortgage payments with a reverse mortgage, the interest is deferred, which means it's added to the loan balance, and the loan balance goes up over time. So this myth is all about the fear that the balance will exceed the home value someday. And if that happens, the homeowner or their heirs will be liable for this debt. So I'm here to tell you that cannot happen. Reverse mortgages are what we call non-recourse mortgages. Non-recourse mortgages are basically stating the fact that the homeowner and the heirs cannot have any financial liability for any mortgage amount that is above and beyond the home's value. So let's break this down. Let's say, once again, you have a $500,000 home, you get a reverse mortgage for $250,000, and that balance goes up and up and up and up over time. The longer you live, the more interest will be deferred and the higher that loan balance will become. Generally speaking, home values on average appreciate 4% per year. Okay, so that's an important component to remember, because not only is the mortgage balance going up over time with the deferred interest, but the home value is also going up over time, which means that there's absolutely equity in the home. However, if the home value doesn't go up, or worse, the home value goes down, and once again, the mortgage balance exceeds the home value, The homeowner nor the heirs can once again be financially responsible for that liability. It's a non-recourse mortgage. So when that homeowner passes away or permanently leaves the home or decides to sell the home, which is our next myth, by the way, I'll come back to, then the maximum that the homeowner or the heir can be responsible for is the home value, no more than that. So once again, if the mortgage balance, let's just say for example purposes, is $700,000 someday, but the home value is only $600,000, the homeowner or the heirs can sell the home for $600,000, and that $100,000 shortfall will not be the responsibility, financial responsibility of the homeowner or the heirs. So this is once again an important factor, because this non-recourse feature is actually what makes reverse mortgages a wonderful product and what I would think is a safe product, because again, the homeowner or the heir cannot ever be financially responsible for a penny above and beyond the value of the home. All right, so hopefully we button that up and certainly address that concern or myth. Number 3 is that you will no longer be able to sell your home. I just touched on this. Again, that is absolutely false. You can sell your home at any time. Matter of fact, we have numerous clients who decide to sell their home. We have clients right now who have just sold their home in Greeley, Colorado, as a matter of fact, who had a reverse mortgage. Okay, they've sold their home. They've paid off the balance of the reverse mortgage to include that deferred interest, and they're taking their proceeds from the sale and actually getting another reverse mortgage on a new home in Montana where they're going to be moving. So once again, they're selling their home, paying off the reverse mortgage, taking the proceeds, and buying a new home in Montana with their proceeds. Furthermore, they're getting a new reverse mortgage to buy that new home so that they're not going to be required to make monthly mortgage payments on that new home. So you can sell your home at any time and you just simply pay off the reverse mortgage balance and the deferred interest. All right, number 4. People think that when you get a reverse mortgage, you're giving up home ownership and the lender now owns the home. Okay, people think that you again turn over the title to the lender owns the house, and the lender is simply giving you money or paying you to live in that house. That is absolutely false. Just like a regular mortgage, there's a loan that means there's a lien on the title of your home, okay, until that loan is paid back. But the homeowner still owns the house. Again, you can sell the house at any time. You can leave the home to your heirs so your heirs can inherit that equity when you're gone, but you absolutely still own the home. Okay? We are just simply giving you a loan that does not require monthly payments. And the way in which you access the equity from this loan can be utilized in many, many different ways. And the funds are free of income taxes, which is also an added plus. So once again, the lender's not taking ownership of your home. You still own the home. That does not change. All right. 5th most common myth for today is that reverse mortgages are only used for seniors as a loan of last resort who have run out of money. I want to be very clear on this, okay? That is absolutely false. We have numerous clients with hundreds and hundreds of thousands of dollars and several clients with millions of dollars of assets under management, okay? They've got retirement accounts, they've got life insurance, they've got long-term care insurance in some cases, and they still do a reverse mortgage because, as I just mentioned earlier, the proceeds that you get from a reverse mortgage are free of income taxes. So once again, a reverse mortgage can be used by anyone age 55 or over who has a significant amount of equity in your home. You do not need to be quote unquote broke or poor or have run out of other assets. Absolutely not. As a matter of fact, I prefer when clients do this earlier in retirement to avoid and prevent themselves from running out of money. That's actually the best time to do the reverse mortgage, is once again when you have money, and this becomes another bucket of money that you get to work with and live from in retirement to protect and preserve your other assets so you don't run out of assets. Once again, so a reverse mortgage can be used in many different situations with clients who have significant assets, where many of those assets, especially retirement accounts, are all taxable, but proceeds from a reverse mortgage are not taxable. And therefore, this is a great way to tap into your home equity free of any income taxes. So we do reverse mortgages for clients who are financially in a bad spot or who have spent down all of their assets. And yes, we can help many of those clients. Absolutely. However, it's better to do a reverse mortgage earlier in retirement before you run out of money to once again protect and preserve your other assets. So hopefully this is very helpful and provides some answers and some clarity on the top 5 misconceptions about reverse mortgages. I'll come back another day and talk about some additional misconceptions. But if we can assist you in any way whatsoever with any of your retirement needs, give us a call at 720-600-4870. Thanks for listening and hope you have a great day.